Welcome everyone to another Lunch and Learn in our ongoing Financial Friday series. SAANYS is excited to offer these sessions in cooperation with our partner, Equitable Advisors. Equitable has a long-standing presence in New York, and a large portion of Equitable's New York client base is built upon the work they do within the public education system. Through Equitable, SAANYS members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for SAANYS members, which we urge you to take advantage of because it's a great benefit. Our Equitable presenter today is Greg Podorski, Equitable Advisors Vice President, East Region. Before we get started, please note that participants are muted during this session, but we'll have some Q&A time following the presentation. If you have a question, just type it in the Q&A panel. We're also recording this session and it'll be available at SAANYS.org within a few days. With that, I'll turn the presentation over to Greg.
Thank you, Annika, and welcome everybody. Appreciate you joining us for another edition of our SAANYS Financial Friday. We know that this is one of the more well-attended sessions about pension planning and really preparing for retirement. So, we figured we'd actually move this up in the cycle a little bit. With everything going on, we know that retirement's been a big motivating factor for a lot of folks, and sometimes the timeline's gotten sped up. So, I'll reiterate this towards the end, but if there are specific questions or any individual planning questions that you would like to have, we do have representatives across New York State. So even if I'm not your local representative, I can certainly help and certainly answer questions, but local representatives from all of our offices who are able to help with some of the individual planning. So with, let's see here. So as far as what we're going through today, again, it's really going to be revolved around preparing for the pension benefits that you're all eligible for. And we always start this conversation with really trying to familiarize everybody with how those pension benefits work, how they're actually calculated, and then some of the decisions that are initially made around those. So with the TRS and the ERS pension with New York State, it's actually one of the best funded pension programs in the US. We hear a lot about this with private industries who used to offer pension benefits, a lot of other states who are maybe going through some issues with the funding of their pension. But the New York State pension does continue to be one of the best funded programs in the country. Ultimately, the pension is a guaranteed lifetime income. Now, guaranteed is in quotes. There can be things that change, but for all intents and purposes, it is something that you can really look forward to from an expectation standpoint as far as that monthly guaranteed of lifetime income. And for a lot of our TRS and ERS members, it is typically the largest source of retirement income. With the years of service that people have put in, with the accumulated benefits, it does tend to be one of the largest, if not the largest, retirement income source. So a lot of our SAANYS members end up collecting a pension benefit between $50,000 and $60,000 a year. And if we stretch that out over a 30-year retirement, that's $1.5 million that you're entitled to from New York State. So it's a very, very big benefit. And again, a benefit that not a lot of people out there have or can rely on. And really the biggest component of this is the consistency and the stability it provides with retirement income and the peace of mind it can provide, because we're not relying on the stock market or other investments to generate that month-to-month retirement income. All right, so again, it does provide a lot of those benefits there. Now, as far as the pension factors go, so we're going to focus on Tier 4, and again, with Tier 5 or Tier 6, there are different benefits and some different calculations there, but again, things that we can certainly talk about on an individual basis. But with most of our SAANYS members being in that Tier 4 and retiring under Tier 4 benefits, we want to try to focus on those. So Tier 4 comes with a few stipulations. So at the age at retirement that you can afford to retire is age 55 with 30 years of service, where there's no penalty for retiring in New York State size. So Meeting that first threshold of 30 years of service and being at least age 55 is a huge milestone to reach. If we're not going to retire with 30 years of service, then being age 62 also alleviates that penalty for retiring without those two requirements. All right. So we do want to be mindful of those 2 points in time. If you retire before age 62 with less than 30 years of service, there's a penalty for not reaching those milestones. All right. So again, it is something that you can leave money on the table. And if you're close to 30 years and you're not going to quite be 62, it can a lot of times make sense to continue going in the state system in order to reach that some of those early retirement benefits. Now, the total years of service are another part of the calculation. So if you retire with less than 20 years of service, you get 1.66% of your pension benefit times your years of service. So with 15 years of service, again, you're going to be eligible for about a 25% pension benefit. With 20 to 30 years, you'll receive 2% per year of service. So somebody with 25 years of service in the state system will be eligible for a 50% pension benefit off of that, off of the final average salary, which I'll go over. With 30 or more years, you get 2% per year of service for those first 30. And a lot of times we'll hear that, well, if I stay longer than 30 years, I actually lose my benefit and I start losing my pension. That's not actually the case. If you stay beyond 30 years, each year after year 30, you continue accruing a benefit, but it doesn't continue to accrue at the same pace that the first 30 years did. So every year after year 30, you end up getting a 1.5% increase towards your pension factor. All right. So somebody with 35 years of service is still going to have a higher pension benefit on a percentage basis than somebody with 30 years of service. The third factor that goes into this is what's referred to as the final average salary. And the final average salary consists of the highest 3 consecutive years that somebody had during their earnings history with New York State. All right, so if year 28, 29, and 30 look something like this, then New York State will take an average of those 3 years, and the average final average salary in this case would be $90,333. That's what your pension benefit is based on. All right, but there's a stipulation here where New York State doesn't let anybody kind of game the system. So if somebody earns 10% more in any year that's included in those final 3 years, one of the there's a few things to be aware of. So if those 3 years went 87,000, 91,000, and then 99,000, that $99,000 earning year would actually be high, more than 10% year 28. So what the expected final average salary would be about 92,000. However, what New York State do is they will cancel out that 99,000 and bring it back to your next highest year. And so your 3 highest years in that case would then be 89,667 on average. So it is something to be aware of. This does get brought up as time goes on and as salaries and benefits and step increases happen. So again, it is something to be aware of just to make sure that we aren't setting ourselves up for a reduction versus what we're preparing or planning for. So with that being said, New York State also offers survivor options. So those total pension benefits there are really based on your single life benefit, which means that your single life is only going to continue for as long as you are alive. There's no survivor benefit there. If we need to plan for a survivor and make sure that that pension income comes in for as long as at least that New York State pensioner and a beneficiary are alive, that's where New York State does provide some options. Now, those options come at a cost. All right. And in this case, the beneficiary taking the single life If something happened to that New York State employee, there would be no beneficiary income. All right. Now, with some of the other options here, the joint allowance option, what that means is that the pension ends up being reduced for the life of the New York State educator and or the beneficiary. So as long as one of those two individuals continues to be alive, that pension benefit will continue. Now, the beneficiary will receive the percentage that's elected. So with the 100% joint allowance option, that same amount that the New York State pensioner was receiving would continue to a beneficiary. With some of the 75, 50%, and 25% benefits here, you can see that the income while that New York State pensioner is alive goes up, but the beneficiary allowance would be less. All right, so we want to be mindful of that, especially when we're doing family planning and looking at this from a household standpoint. Now, the other alternative here is called the pop-up option. And the pop-up option is a little bit different. All right, but basically what that means is that the New York State pensioner will continue to have a reduction, all right, in their pension benefit in order to provide an income stream to a survivor. All right. Now, again, it's similar to the joint allowance in the sense that there are different percentage vested benefits where the vesting percentage will continue based on that election at retirement. So if the New York State educator passes away, that beneficiary would continue to receive that pension benefit. However, the difference with the pop-up option versus the joint allowance is if the beneficiary predeceases the New York State pensioner, that New York State pensioner pops up from that reduced amount to their single life amount. So it does provide some flexibility, not knowing what the future exactly is going to hold. All right, so there are some things to be aware of, but as we're going through that pension discussion and looking at which elections are most appropriate and what can we reasonably expect from a pension standpoint, we do have to take into consideration, are we planning for one or two people? And how do the reductions in pension benefits affect our annual income needs? As great as the New York State pension is, there are some downsides. The first one is the inflexibility in retirement. So once that pension election is made, 30 days after retirement, nothing can be changed. So unfortunately, we can't go a couple of years into retirement and say, you know what, we don't need we don't need the survivor benefit, or we're not really getting as much as we need in retirement income. We want to change that after those 30 and so on. The beneficiaries can also not be changed. So regardless of any personal needs or, again, income needs or family or marital changes, there's nothing that can be changed from a beneficiary standpoint. All right. There's also very low cost of living increases. All right. I'll go through that in a couple of minutes, but it is something, especially with all the conversations around inflation that we hear about in the news and from an economic perspective, there are considerations there with cost of living increases. And then taking some of those survivor benefits can have a 10 to 20% permanent reduction if we do need to plan for that. So again, things to be aware of. There's also no pension if the New York State educator passes away before retirement. There's something called an in-service death benefit, which does provide some income protection, but generally speaking, it doesn't cover the amount of that expected future pension benefit. So again, something to be aware of. And then if there's a early retirement before the TRS age and years of milestones, before those times are met, then again, that can lead to a permanent reduction in what the total income benefits are from New York State. So those benefits for Tier 4, so if somebody were to retire at age 55 with 29 years of service with the state, the pension calculation would have a 20% reduction for not meeting those 30 years of service. As time goes on and we get closer to age 62, not having those 30 years of service, the pension reduction, the penalty does get reduced, but it is still there. So again, that can have a pretty significant impact, especially when we look at the income reduction over the course of the projected retirement. So there are ways to maximize your pension benefits. And this is, something we'll spend a little bit of time on here, but I'm trying to be mindful of the amount of information, but also the time that you've all given us. So let's assume that somebody retires at age 55 with 25 years of service. All right. Again, you can see that there's a pretty substantial reduction in overall income. With some of those reductions there, the 30 years, so if someone were to reach the 30 years of service and not have a penalty, their projected income, again, over the course of their retirement might be in the neighborhood of $1.5 million. But by not reaching the milestone of those 30 years and potentially retiring before age 62, the reduction there would lead to lifetime income from New York State of about $1.1 million. So that's a $400,000 decision over the course of time to not reach some of those milestones and maybe retire early. Now, we're certainly not here to say that everybody has to work till 30 years or work until age 62, but this is all part of the planning conversation to make sure that you're maximizing what you're eligible for, and again, accounting for any reductions that might be part of that discussion if we do end up retiring without those milestones being met. Another planning thought here is how we can prepare for these survivor benefits. So the survivorship calculations that New York State has are all based on the potential beneficiary's date of birth with New York State. All right. So TRS calculates the New York State pension benefit as well as the beneficiary's date of birth. And then based on those calculations, again, that's where the reduction comes into play for some of those survivor benefits. So ultimately, what TRS is doing to a degree is purchasing life insurance to be able to pay that remaining benefit to the named beneficiary. Now, the life insurance cost is the difference between the single life amount and whichever survivor option is elected. So if we look at that pop-up example here, there's about $7,600 that New York State pensioner is leaving on the table every year by making sure that their spouse or significant other is protected and able to continue that same income stream. So one of the considerations, and this doesn't work for everybody, but I'll touch on that. So instead of allowing New York State to purchase that life insurance, it's possible at times to purchase individually owned life insurance to see if we can satisfy that same survivor benefit without giving up the pension. So what that would look like would be purchasing, maybe, again, making up numbers here because this is an individual basis, but an $800,000 life insurance policy may cost $5,000 a year. So instead of the state option, if that New York State pensioner can take the single life option, so in this case, $60,000, pay out of pocket $5,000 a year for that life insurance benefit, with the beneficiary being their spouse or significant other. Well, now their retirement income is actually $55,000 a year versus the $52,000 reduction. I'm sorry, $52,000 total income that New York State was going to provide. So we're maximizing how much income we can get from New York State while still protecting that potential beneficiary. So if the New York State pensioner passes away, that $800,000 in that example would be able to pay out tax-free to the beneficiary, knowing that there's no more income coming from New York State. If the beneficiary passes away, we can cancel the life insurance because we're already collecting that single life pension, and we're effectively doing the same thing as that pop-up option, where we're now popping up and we still are collecting that single life pension with no more $5,000 a year life insurance premium. We also retain the flexibility to change beneficiaries on the life insurance, reduce the amount of coverage, reduce the annual premium. There's other considerations that give us some more flexibility as time goes on. All right. But ultimately, that's what the pension planning is really about. And the longer runway that we have to do that planning, the more choice and the more flexibility we can retain once that time comes. So I'll finish this thought with saying that this does not always work for everyone in every situation, but based on the joint needs, based on survivor benefits, based on the current financial situation, there are different options that we can look at and explore to see if this does fit a personal or individualized situation. All right. So again, just to kind of give a roadmap here of how that would look. So the single life pension option would be elected at retirement. The highest income benefit would continue while both people are living. And if the TRS employee passed away or the spouse passed away, the goal of that insurance planning is to really make sure that we're still taken care of. Again, the TRS employee passes away, the spouse is going to be taken care of through the tax-free lump sum death benefits. Also gives the ability for some of those proceeds to produce income for children or other beneficiaries. If the spouse of that TRS employee passes away, then you can change beneficiaries, again, cash in the life insurance if it does have cash value, or reduce or eliminate the life insurance premiums. So it still has some of those components that New York State are offering in their choices, but this is just an individual versus taking that New York State option. Now, as far as looking at some of those retirement income sources, again, with the pension benefits being one of the largest or potentially the largest source of retirement income, we also have to take into consideration some of the other pieces. Social Security will eventually be another big decision. And we know that there's some concerns around the viability and sustainability of Social Security income. But from a practical standpoint, we're anticipating Social Security will be there in some way, shape, or form. All right, so looking at what we can expect from Social Security, when you can collect or when it might make the most sense to collect Social Security, these are other considerations to look at. So the earliest you can collect Social Security is age 62, but if you're still working or have part-time income or don't need the funds from Social Security early in retirement, the longer you delay collecting, the more you're going to receive from Social Security over time. All right, so again, this is a very individual conversation depending on where the financial household falls, but these are things that we want to look at in conjunction with your New York State pension benefits. All right, so in closing this slide out, Social Security is certainly not a one-size-fits-all solution. We hear a lot of times that I'm collecting it as soon as I can, or so-and-so told me that I should get my benefits as soon as I can retire. But again, it doesn't always make sense, especially in looking at all of the entire income may be coming from. So again, another big thing that we're hearing about on the news right now is inflation. All right, and just to go over how inflation works relative to the New York State pension and some of the planning that should go into retirement. If we looked at somebody needing $75,000 a year this year for retirement, by the time, let's say 15 years into retirement, so in 2036, that individual is probably going to need about $116,000 just to buy what $75,000 buys today. As time goes on, the needs of our income continue to increase throughout retirement. So again, this is a big consideration that we have to keep in mind. But the reason we always want to touch base on this and going through the conversation around pension planning and Social Security has a cost of living adjustment. And in 2022, those adjustments are going to be 5.9% for Social Security checks. All right. So somebody eligible to collect $2,000 this year in Social Security, their check is automatically going to go up to $2,180 next year. All right, reflecting that 5.9%. Now, you might not see all of that in a check because Medicare costs do increase over time. Medicare can come out of those Social Security checks. So it might not be $188 a month here, but your total income benefit will go up that much. Now, relative to the teacher's retirement system, there's a couple of major nuances to be aware of. So TRS inflation adjusts from September every year through the following August. So even though Social Security inflation adjustments were 5.9%, the 2021 to 2022 inflation adjustment for TRS pension benefits is 1.4%. But there's another big caveat. So if we were to say that that check was $5,000 right now, we would expect 1.4% of $5,000 would be $70 per month of an increase. All right. But TRS, the cost of living adjustment, is only calculated on the first $18,000 of your pension benefit. So that 1.4% is only on $18,000. It would only give an adjustment of $21 a month. All right. So that pension check going into year two, once you're eligible for those inflation adjustments, would only go from $5,000 a month to $5,021 a month. So the point of going through this is, unfortunately, as time goes on, the cost of living adjustments with the New York State pension system do not actually keep up with the cost of inflation in general. So how do we prepare for that? How do we plan for that? One of the pieces, and actually I should mention here as well, that surviving beneficiaries. So if you are not the original New York State pensioner, but you're a surviving beneficiary receiving a pension benefit, you only get half of that amount that the New York State pensioner would have been eligible for. All right, so another caveat there. But how do we prepare for maintaining that standard of living while making sure that our income needs can be met? Well, one of the big ways is by filling the income gap by using things like 403Bs. We are the largest provider across the country of 403Bs for public school employees. We work with a lot of our SAANYS members to help look at all of these moving parts, but that's one of the biggest components, is making sure that there's supplemental retirement savings that can bridge the gap between inflation increasing over time and the smaller increases that you'll see through Social Security and the New York State pension benefits. So we always want to make sure that the standard of living can be met. There's different ways to do that between traditional 403Bs, Roth 403Bs. There's a lot of considerations on how to set those up and how to structure them, but those are all things that we're here to help with. We certainly don't want to give the impression that we just set up the 403B, say good luck along the way. We'll meet you at retirement. There's a lot of decision making along the way to make sure that your 403B stays in line with those retirement goals, and that the 403Bs and pension benefits and Social Security decisions and all of these moving parts of the retirement picture are really looked at in a cohesive, holistic way. All right. So with that being said, there's certainly been a lot of volatility in the stock market over the last. All right, there's been some ups and downs, and although things are certainly better today from an investment perspective than they were years ago, there are decisions that we need to be mindful of. So again, going back to the recommendation of TRS really looks at the last 18 months of working is when you should start lining up some of these priorities. Our view is that this is way too close to the finish line to really be able to make adjustments to put you on a good track and make sure that the needs of retirement can be met with some of the decisions we made over time. We really want to make sure that the longer that we have to plan, the higher chance that we have of having that financial success. So understanding the future benefits now, looking at should we be thinking of spousal benefits or legacy planning, all of these decisions that go into this, we can implement when the time is right. So we're not making final decisions on pension elections, when to collect Social Security, but there are things that should be part of a sound financial plan today in order to make sure that when that time does come, there's already a game plan in place. When we're looking at this from the last minute perspective or getting close to the finish line, we're more limited in choices and decisions and making adaptations to what we've done to really prepare ourselves. So again, the longer that we have to plan, the more prepared we can be. Right. And I'll close with this and then I'll open it up for some Q&A. But really where we help our clients and help our SAANYS members is making sure that there is a snapshot of that personal financial household. So looking at things like your pension benefits, social security estimates, current retirement accounts that may be in place, debts and expectations around when they're going to be paid off or if those debts are going to be carried into retirement, looking at cash flow analysis, spousal retirement benefits, college savings, right? We know that there's all these different priorities and goals that our clients have. It's not just centered around retirement, but how do we prioritize some of these different goals and make sure that we're giving ourselves the best chance to, again, achieve these as time goes on. So this is something that's called an asset map that we use with all of our clients to make sure that we're taking that financial snapshot of the household. So if we're looking at this from that household perspective, we want to really just get both sides of the household lined up with what can we expect from these different income sources, what's in place today, what are those immediate liabilities or future liabilities going to look like. These are things that really give us that financial standing of here's where we are today. And then from there, we can do a lot of that. Here's where we can expect to be down the road. All right. And again, those two pieces, looking at it from a current and a future standpoint, can then help us determine, are there things that we should be doing today or implementing today or changing today that are going to help us achieve these future expectations for when retirement happens. All right. So again, with that being said, we have representatives all across the state. So any region that you're in with SAANYS, you have local representation that you can get in touch with those folks. Again, feel free to ask any questions today. If they are individual or they are specific, I will, I'll leave this up so you can reach out to your local representatives. But again, tried to stay on time here, so I'm about 2 minutes over. But again, we appreciate everybody for joining today. Hope everybody's having a great start to the school year. We know it's a challenging time to be in education, but again, we certainly appreciate the partnership with SAANYS, and we look forward to helping any way that we can.
Thanks very much, Greg. We do have one question, so I'll go ahead and read that now. They say they have 30 years. They won't have 30 years by 62, but want to retire by then. Can drawing on the system be deferred until 62 to avoid a penalty?
Generally, it can. It's very rare to see an instance that it does make. There's no accumulation of future benefits. Depending on the age that we're going to retire, we'd be leaving potentially years of pension benefits on the table to have a higher benefit down the road. But it doesn't always make sense to do that from a numbers perspective. But that's certainly something that that we could look at to see if it is something that we could do, and something that would make financial sense. It's more often than not, it's something that's not always financially practical. But again, it is definitely a situation that we could look at closer.
There's a couple questions about whether they'll be able to receive the slides and PowerPoint. We are recording this presentation, and it will be up on the SAANYS website within a few days, probably early next week. And then, another question. How do vacation buyback at the time of retirement and sick time buyback at the end of fiscal years affect FAS? How does the 10% rule apply to that?
So generally, retirement and sick time won't count towards your final average salary. The final average salary has some specific requirements on the calculation that it can only be factored in with regular ordinary income, like things like raises or maybe longevity bonuses, certain things along those lines. But the sick time and vacation time generally don't impact the final average salary. Depending on the contract that everybody's in and the wording of it, that can be different, but generally speaking, it doesn't affect the final average salary. If it did, that 10% will apply to that total income. income.
Okay, it looks like we don't have any more questions at this time. If you do think of anything, please go to the SAANYS website to contact your local Equitable representative with any other questions you might have. Thanks again, Greg, and have a great weekend, everyone.